So the question was, primarily the primary policy tool are interest rates, and the question is, could you speak about the balance sheet of central banks, in particular the Fed, and how do you think of that in terms of effects on inflation? Did I get that right? Yeah, okay.
Well, I definitely try to present a broader picture of the challenges of central bank and not necessarily focus on the Fed. Of course, the most important central bank in the world is the Fed, and you set the tone in many different discussions. Now, the way I see it is the following. The central bank, what monetary policy is the ability of the central bank to use its balance sheet and the terms at which it affects its balance sheet. The interest rate policy, doesn't work independently of some form of balance sheet implications. In the speech, basically what I try to address is the importance of monetary policy framework reviews. Why this is important? Because inflation targeting regimes that are basically the predominant regimes in most central banks, it's a very primitive way to try to anchor inflation expectations. It's basically to say to the public, this is my inflation objective, and in principle, I will do whatever it takes to hit that target. But we never are that specific about it. Now, by construction, that has its advantages, but it also has its disadvantages. So basically, I think through the monetary policy framework reviews, you fill the gaps of information. Now, if you consider that central banks should be flexible in the use of their instruments, they should have flexibility in how they use it, both in interest rates and in balance sheets. Now, I'm not somebody who is inclined to establish quantitative targets on quantities, because the traction of that on the final objective is relatively low. Now, I think that under certain conditions, the use of balance sheet tools like quantitative easing was done to an excess due to the concerns of the ELB, and in principle some form of a correction should take place. But at this stage it should be gradual and is not of first order of importance. I think it's something that through time it can be dealt with, and I don't think that necessarily it compromises the integrity of the monetary policy framework. My recommendation for the future is to try to depend less on quantitative-based measures and depend as much as possible on interest rates and probably forward guidance.